Good morning. I want to welcome everyone to today's webinar covering internal controls. Let's take a minute here. I'm going to introduce everybody here with us today. My name's Tyson Moore. I'm supervisor. Also joining us today is Director Phil McKenzie and our presenter and partner, Carrie Minnick. So just as a reminder, the webinar is live, it's interactive. So as Carrie goes through the presentation, Phil and I will both be answering questions via chat. If you have questions, please use the question and answer feature. You should see that at the bottom of your screen. Also, after we're done today, Carrie's going to share all of her slides via email. All right, looks like Carrie's ready. I'll pass it over to her to get us started.
Thanks, Tyson, and thank you all for attending today's webinar. Today, we're going to be talking about internal controls. There's three primary goals we want to cover today. First of all, understanding what internal controls are and why they matter to your organization. We're going to talk about some practical internal controls that can be scaled to fit any size organization, and then also some example policies and procedures that you can implement with your organization. So first, when we talk about internal controls, what are we talking about? It's not just preventing our cash from being stolen or someone walking off with our fixed assets or our equipment. That is a piece of it, but it's also ensuring the accuracy of our financial reporting, making sure that there's controls in place so that transactions are reported properly. Promoting compliance with laws and policies, not only for Form 990, but also for your audit, for an E1 that you have to file with the state if you've received government funding, or any other type of reporting that your organization has to do. And then as well as achieving organization goals. When we talk about internal controls, the COSO kind of comes to mind. And if you are an audit, if you receive an audit from DWD, you will probably, this might sound familiar because we do send out a COSO questionnaire for our audit clients to complete. So what COSO is the Committee of Sponsoring Organizations of the Treadway Commission. So it is a joint initiative of 5 organizations, and they came together to establish and develop how effective controls, a framework really on providing a means to apply internal controls to any type and any size of organizations. So just not large public companies, but any type of company, whether it be a private, whether it be a nonprofit, whether it be a small, large, regardless of the size. These overarching framework can be applied to any type of organization. Now, when you look at the screen, we have 5 different components of internal control, 17 principles for effective internal control. And then there's also maybe, I don't know, additional like 81 or 61 additional pieces that fall under the principles. So it might be overwhelming. However, we want to take a look based like what this means to your organization. How can we apply it to your nonprofit? Even if you are a small volunteer-run nonprofit, how can we apply these COSO framework to help with internal controls? So we're gonna specifically talk about the 5 components of in control first. The first is the control environment, and I have some examples on the screen of each one of these that you could implement within your organization. But the control environment is really about setting the tone at the top. It involves creating a culture where everyone understands the importance of internal controls and compliance. Think of it as creating an environment where everyone knows what's expected and follows the rules. So this can be done by outlining a code of conduct, an ethics policy, making sure that everyone within an organization is aware of that policy, has a copy of that, and also that your management, your CEO, your executive director, and your board of directors are applying that they are living this code of conduct or ethics. Because if they are not providing the example, then the staff, volunteers, other people are going to follow their lead. Next is risk assessment. Here you identify and assess potential risks that could affect your organization's ability to achieve its goals. It's like taking a look around to see what could go wrong and how bad it could be if it did. So it doesn't have to be any kind of massive, drawn out documentation policy that has to be implemented. Sometimes when people think of risk assessment, they think of all this extra stuff that they have to do. Really what you want to do is have a conversation within your organization and talk about what are the risks. So for example, maybe not in Indiana, but in other, maybe Florida or California, there's the risk of like a natural disaster. So you could have a natural disaster. But what about the risks associated to your funding? So if you receive a huge amount of funding from one specific source or from a government entity, what is the risk that that goes away? So you want to see where are the risks that are associated to your organization? And then what is the chance of those actually happening? And then what's going to be done if that happens to prevent it? So it's a lot of discussion talking about within your organization, what could happen to prevent your organization from accomplishing its mission? Next are control activities. So these are the actual actions or procedures that you put into place to address the risks you've identified. And we're going to talk about some of the examples of these in a little bit. So a big one is segregation of duties, making sure that one person can't do everything within cash receipts processes or one thing within payroll. So segregating the duties as much as possible, and then also providing additional controls like sign-offs and reviews and those types of things. Next is information and communication. So information and communication is about making sure everyone has the information they need to do their jobs effectively and to follow the rules. It involves clear communication of roles, responsibilities, and policies, as well as sharing important information about risks and controls. So making sure that everyone has, all the organizations have written policies and procedures in place, making sure that you have job descriptions, making sure that when changes are made, those changes are communicated to everyone that needs to be aware of that, making sure that there's regular staff training on sessions that they need to know about. If you have a new government grant that you just received, making sure that everyone is aware of the requirements, what needs to be done with that. So again, it's communicating to everyone that's involved so everyone knows what's going on. If they don't know what's going on, they can't follow the controls or policies. And finally, we have monitoring. So this means that you really need to regularly monitor and evaluate your internal controls to make sure they're working effectively. It's like regularly checking to see if everything is still running smoothly and fixing anything that's not. So, you go in and you put these controls in place, you talk about your risks, and then you put the controls in place to prevent certain things to happen. But you need to also follow up and monitor those to make sure that it's working, or maybe something has changed. And so we need to change that controls. Some ways that you can do that is to have internal audits conducted on different areas within the organization, or making sure that management's reviewing those financial statements or key indicators of things to make sure that things are working properly. So in essence, the COSO controls help nonprofits ensure they have the right rules and procedures in place. Everyone knows what they are, and they're being followed to keep the organization running smoothly and minimize risk. So that's really, in a general speaking, what that COSO framework does. Next, we're going to talk about segregation of duties. Segregation of duties within nonprofits sometimes can be difficult, especially those organizations that have limited accounting staff. When we come out and do audits, we do walkthroughs and talk about, processes and procedures and who does what. And oftentimes, segregation of duties is not necessarily we're at the level that it should be or could be with an organization because of limited staff. Now, we don't necessarily think that you should go out and hire 8 more people to add to your accounting staff, because obviously if you had the funds to hire 8 more people, you're not going to hire them into your accounting staff. They're going to go to programming. But what we need to think about is what is segregation of duties, and how can we, with the people that we have, how can we segregate duties as much as we can? So when we talk about segregation of duties, there's 3 different areas that we want to make sure are separate: authorizing the transactions, recording the transactions, and maintaining custody of the assets. So we want to make sure that one person can't do all 3 of those things. So I have some examples here from the AICPA not-for-profit section. And again, these slides will be emailed out to everyone after the session today, so you'll have a copy of this. The first slide here talks about how you can segregate duties if you have 4 people. The 4 people listed here are the ED, two accounting staff or / other. Now, when you think about segregation of duties, it doesn't necessarily have to be all accounting staff. It could be someone that's not in the accounting department. The key is here that we want to have 4 different people. And you can see here how they've kind of allocated the different work between 4 people. The next slide shows if you only have 3 people that you'd be able to allocate duties between. And then finally, we have just 2 people. Now, obviously, allocating duties between only 2 people isn't the best plan, isn't the ideal situation. However, if you are limited, you want to make sure that you can segregate certain duties between the people as necessary. If you are limited in your staffing and you don't have people that can help segregate duties, you can always consider using your board of directors, especially the treasurer. Get them involved to provide some additional oversight. The key about segregation of duties is thinking about, okay, what can this person do? If nobody else is in on it, if this one person, could they write a check to themselves with the organization's funds? Could that check clear the bank statement, and the money taken out, the bank reconciliation be done, and no one else notice it? Or if money's coming in, could someone obtain that check or that payment that came in? Could they take it? Could they somehow put it into their bank account and take it from the organization without anyone knowing? So you kind of have to think like a fraudster when you're thinking about this. Someone that's going to do some bad stuff is, okay, if I was in that position, what could I do to commit fraud? And if you really want to put into place those controls to help prevent that fraud from happening. So when we talk about internal controls, segregation of duties is a huge piece of the controls and implementing those properly. Next, we're going to talk about some key policies and procedures, and these are written policies that are specifically related to controls right now. Obviously, there are other written policies and procedures that a nonprofit should have in place, but as far as what we're talking about today, internal controls, you really need to make sure that you have these policies in place. A conflict of interest statement. This is usually signed annually by the board of directors and management to say who is, if they have any conflicts with any vendors or any individuals that the organization works with. Now, it's not necessarily that the organization can't do business with related parties or these individuals that they're noting on their conflict of interest statement, but you just everyone needs to be aware of it. Also, you need to make sure that nobody's benefiting from that relationship. That's really the key of this, is the conflict of interest, is making sure that nobody's benefiting from the relationship and you're disclosing these possible conflicts. And then also the individual that may have a possible conflict does need to recuse themselves from any kind of voting or determination in relation to that business with that individual. When an organization applies to the IRS to become a nonprofit, the IRS does ask for a conflict, if you have a conflict of interest statement in place, policy in place. So those organizations that have recently received their nonprofit status probably has one in place. Those older organizations, hopefully you have one in place, but if you don't, let us know. We can provide a sample. We'd be happy to provide those to you. The next two, the whistleblower policy and the document retention and destruction policy, are 2 policies that came out from the Enron scandal many, many years ago. There were several items in that scandal that required for-profit entities to do certain things. These are the 2 policies that were required of nonprofits as well. The first is a whistleblower policy. So that basically provides a method for someone to report any kind of wrongdoings that they think are going on within the organization. Within the policy, there also needs to be protection from retaliation so that the individual is not going to be fired for any kind of reporting. And then the document retention and destruction policy provide guidance on how long the organization needs to keep certain documents, whether it be board minutes or tax returns, your 990, bank statements, all those types of documents, how long you should keep them, how you should dispose of them. And then also there should be a statement in the document retention and destruction policy that says that if a lawsuit is imminent, or if you think a lawsuit was currently in place, or think you're going to have a lawsuit happen, that you need to stop destroying any documents. So again, if you don't have these policies in place, I would highly recommend that you put them in place. And if you need copies, just let us know. We're happy to provide those to you. So those were some required documents. Some other sample policies that you might want to consider putting into place if you don't are the ones that we have listed on the screen now. Obviously, this is not encompassing all policies that you should have in place, but these are some key ones that you might want to put into place. A monthly close checklist. So this outlines all the steps for timely month-end closing and review. So you want to make sure that at the end of the month, all of your transactions are properly recorded into your accounting system, whether it be QuickBooks or MIP or whatever software you use, making sure that everything is in for the month, also for the year end. Payroll, making sure that there's a process in place to put approvals, to review the timesheets, the payroll registers, to make sure that everything that the hours that are being reported have actually been worked by the individuals that are actually employees, making sure that they're getting paid the correct amount, making sure that the proper taxes are being taken out. So making sure there's some kind of policy in place to ensure that payroll is being documented and paid properly. And then bank reconciliations, making sure that there's some kind of procedure in place to make sure that bank reconciliations are done each month. We will talk more about bank reconciliations in a little bit, but the bank reconciliation is really a key, not only financial process, but control mechanism as well, because everything is going to go through your bank statement. So you want to make sure that you're reconciling that properly each month. So next, I want to talk about specific controls, and this is where we're going to spend much of our time today, is talking about specific controls that you can take and implement into your organization if you haven't already. So the first is going to talk about bank accounts. So the risks here includes the theft or use of cash for non-business related payments. So someone getting access to your bank account, taking your cash that these people should not be taking your cash. So first, limit the number of accounts that you have. So I know that organizations, sometimes you have to have multiple bank accounts. Maybe you have to have a checking account, you have to have a savings account, maybe you have to, because for FDIC limits, insured limits, you want to spread it across different banks. That's fine, but just watch how many accounts you have. The more bank accounts you have, the more risks that you're taking on. Limit the number of check signers. So obviously you're going to have authorized check signers that can access bank accounts, that make payments, sign the checks. You don't want every person on the board to be a check signer. Think about who are the check signers, who needs to be a check signer. Also, if you have board members that are check signers, let's say your president, your treasurer, as soon as their term ends, make sure you change the authorized check signers with the bank. There's been numerous times where I have seen there's turnover in officers and those bank authorized signers do not get updated. So please make sure that you do update that so you have the current authorized check signers in line with the bank. Online access, many organizations now have online access to their bank accounts to do online banking or to access bank statements, that type of thing. You want to just make sure that you know who has online access and what can they do. There's different levels of access that someone can have. So someone might be able to just download reports. Someone might be able to actually make transactions or make payments or make transfers or withdrawals. So you want to make sure that you're aware as who has that access to your online bank account and what can they do. So limit that access. Okay, monthly reconciliations. I want to talk about bank reconciliations because it's so important. And so oftentimes we see that they're just not being done correctly. When you reconcile a bank account, we want to make sure that all activity on the bank statement has been properly recorded in our general ledger. So into QuickBooks or whatever software we're using. We also have to make sure that the reconciled balance on that bank reconciliation agrees to the general ledger. That second step sometimes gets missed. If it does not agree, we need to figure out why. Sometimes you will have outstanding items. You'll have reconciling items like deposits in transit or outstanding checks that haven't cleared the bank yet. That's perfectly fine. That's reasonable that you would have those items. But if you have outstanding journal entries on your bank reconciliation, that is probably not correct. Because if you're making a journal entry in your cash account, then that's normally for something that has already cleared the bank statement. So if you have journal entries on your bank reconciliation as outstanding items that haven't cleared, that's probably incorrect. As part of the bank reconciliation process, we also need to make sure that it's reviewed by the proper member of management. The bank reconciliation should not be prepared and reviewed by the same person. It needs to be two different people. When the individual reviews the bank reconciliation, they need to document that they did that. So they need to put their initials and dates on the face of the bank statement that they did that, or on the bank reconciliation. They need to look at the bank statement and the bank reconciliation. They should be reviewing the activity. They should look, if you happen to be able to get your canceled checks back from the bank, they should be looking at those to see, hey, are these vendors the names that we normally pay? Are these checks being paid by an authorized signer? They should look at outstanding reconciling items. Are these reasonable? Do we have journal entries? We shouldn't. Are there old outstanding items? If there are old outstanding items, are they correct or do they need to be adjusted? So the bank reconciliation is a huge, not only control mechanism, but also financial piece that needs to be done monthly. Now, if you use QuickBooks, sometimes your bank reconciliation from a prior month will get off from your general ledger. And that is because if you go in and void checks within QuickBooks from a prior period, QuickBooks will take that check out of the period from when it was initially put in. So it will be like it didn't happen. And so therefore your general ledger will now no longer agree to your bank reconciliation at that time. There is a different way. There is a proper way to void checks within QuickBooks by adding a journal entry and then voiding it. So it keeps that number in there so your bank reconciliations do not get off. If you would like assistance on how to do that, please let us know and we can provide that to you. But that is also something that we see sometimes. All right. One bank account equals one general ledger account. So we've seen sometimes where we have multiple general ledger accounts get added together to equal one bank account. Sometimes people try to do this if they're trying to track restricted cash or cash that's balances for a specific grant. It's much easier and less risky if you have one bank account to one general ledger account. When you have multiple general ledger accounts, you're going to have increased risk as transactions between the different general ledger accounts. It's just going to be harder to reconcile as well. So we always like to do one bank rec, one GL account. Limit access to blank checks. Obviously, we don't want someone that's not supposed to have blank checks to have access to them and make unauthorized payments. Bonding employees who handle checks and cash. And then finally, debit cards. Please, please, please do not use debit cards. Use a credit card. The use of a debit card is basically giving whoever has that debit card unrestricted access to your bank account. That debit card is linked directly to your cash account. So we really encourage organizations to not use debit cards, but to use credit cards. Along with that, ATM withdrawals. No, we don't want to do that as well because that does not leave any kind of documentation. Also credit cards, if you have some kind of charge that you don't think is legit and you want to dispute it, it's much easier to dispute it through a credit card versus a debit card. So that's kind of, again, this is not like all encompassing controls, but these are some things that we are very common that we see that we think would help with specifically with bank accounts. Moving on to the next one as far as receipts. Oh, someone did ask a question I see about how do you document everything? when everything is electronic, you don't have to keep everything on paper. We are totally fine with that. You can keep things electronically, and that would be within your document retention and destruction policy. You would say that the items are saved electronically. There are different ways to document like the approval and review of electronic documents. We have one client that's pretty slick. They have this really nice system within Adobe, and I don't know exactly what the tool is that they use, but every invoice has like the email as to who approved it, when a timestamp and everything. So there are different ways to do that. But yeah, as we talk about documentation and review and approvals, that doesn't mean that it has to be done on paper. It can certainly be done electronically. You just need to figure out the best way for your organization to make sure that you're still documenting receipts, invoices, bank statements, bank reconciliations, keeping these all in a system, and then also the approvals in a way to document the approvals. Okay, moving on to receipts. So money coming in. Making sure that handling of the receipts is independent of the accounting. Again, we talked about segregation of duties. So we want to really segregate the opening of the mail versus recording versus taking the deposits to the bank. Because the risks with the receipts include theft of the receipts, the money coming in, but also misstatement of revenue. So like overstating revenue, recording revenue that you didn't actually get. And then also for nonprofits, it's the misuse of restricted funds. So with nonprofits, a donor can give a contribution or a grant, and they can restrict it for a specific purpose. As the nonprofit, it's our responsibility to make sure that that money is used for that specific restricted purpose and not for operations. So we want to make sure that we have policies and procedures in place to make sure that we're using it for that restricted purpose. So as far as when we get receipts in, when we receive the checks in or credit card payments in, we should probably make a list of the receipts that come in. So we have one person here that makes a list of all of the receipts. And then that list will end up going to ideally to the person that looks at the bank reconciliation, that reviews the bank reconciliation. So that way that person can compare, hey, this is all of the money that came in, and look, it all agrees to what was deposited into the bank statement. So making sure that all funds are coming in, are ending up in the bank in the bank account. Immediate endorsement of all receipts. So, you have your stamp that says for deposit only on the back of the check. Timely deposits. I don't think this is a huge issue, but just making sure that you're not getting a bunch of checks and that they're sitting in someone's drawer. Making sure that you take those to the bank as soon as you get them. Sending thank you letters to donors. So some people might not think that this would be a control mechanism, but really it is. So first of all, donors have to have some kind of documentation from the organization in order to deduct a contribution on their 1040. But so they're expecting that. But also many donors will expect some kind of thank you, especially if they've given before and have gotten a thank you letter from the organization. So if they don't get one, they might reach out and say, hey, ABC organization, did you get my donation that I sent in? And you can say, oh, yes, we just haven't sent the thank you letter, or no, we didn't get that. So what happened to that donation? Where did that end up? Did it get lost in the mail? Did someone, take the check off the top and steal it when it came in? So it kind of provides that additional oversight control of money coming in. And then lastly, reconcile your donor database with your accounting software. This is a big deal, especially when we do audits. Oftentimes, an organization will have their accounting software, which will be Intact, QuickBooks, MIP, whatever they use. But then there'll also be a second accounting system, or not accounting system, a second computer software, some kind of donor database software, which the fundraising department uses, or the development department uses, to track donors and the money that they came in. So the two, accounting department and development, they want to do the same thing, hope that the organization's mission is successful. They just do it a little bit differently. So sometimes revenue deposits get recorded a little bit differently in the donor database than in the accounting software. So, and that's just because of timing and how on the accrual basis, things have to be reported for accounting. And so it is expected that those would probably be different, but you want to make sure that you're reconciling those at least monthly. The reports between the development department and the accounting department to make sure that you have accounted for everything. Communication between those two departments is so key within a nonprofit organization. To make sure that you're not missing anything, especially when, you know, the development people go out and get contributions from various donors, making sure that, yes, we got one, do we need to record it? You know, the pledge is receivable and such. So the reconciliation between those two departments is really key to make sure that you have everything reported properly. Next is the opposite side, disbursements, so payments out. The risks include, for disbursements are paying for non-business expenses, so expense like personal expenses, expenses that aren't related to the nonprofit's or mission. Overspending, so we're spending too much, it wasn't in the budget, we're spending way too much money, or misclassification of expenses. It's really important to classify your expenses properly, not only by what type of expense, whether it's, you know, rent or supplies, but also by function. All nonprofits are required to report expenses by 3 functions: program, management, general, and fundraising. That is a requirement by the IRS. That is a requirement by accounting standards. And that's also a requirement by the Uniform Compliance Guide, which is single audit. So it is very important that you are recording these in the proper classification. Also, if you get government grants, making sure that those disbursements are recorded properly under the correct grant, because that is a risk too, that you're bringing in money from a specific grant and you are paying expenses that aren't allowable under the grant. So making sure that those are classified correctly. So what can we do related to disbursements? First, use pre-numbered checks. We want to make sure that we can account for all the checks, whether they've been issued, whether they've been cleared, whether they've been voided. So making sure that all checks are pre-numbered or accounted for. I have noted sometimes clients will have different bank accounts at different banks, and they will use a similar numbering system. So I would recommend not doing that because that can also get kind of confusing. So the key here is that you want to make sure that you can account for all of your checks that you've issued. Do use checks for all major payments, just because there is a documentation of payments, and this is opposed to using cash. No pre-signed checks. We don't want to sign any blank checks. When the person signs the check, they really should have the invoice or supporting documentation with them so that they can look at that before they're signing this check. That way they know that, yes, this is to this vendor. Here is the invoice from that vendor. It is for this amount. Here is the invoice that shows that amount. And here is the purpose and that is on that invoice. And that is a legitimate purpose of what our organization needs to pay for. Please don't write any checks that are payable to cash. If you have petty cash and you need to replenish the petty cash fund, it really should be written out to an individual. Now, obviously, you can put the individual's name and say, you know, note on there, replenish petty cash. But if you write a check just to cash, anyone that has that check, they can cash it. So again, adding an individual's name restricts who has access to that cash. If you have to void a check, make sure that you deface it properly, and also make sure that you maintain that. So again, that you can account for all of your organization's checks. I noted the review of invoice when the check is being written. And then also just making sure that you maintain each check that goes out, each payment that goes out should have some type of supporting documentation from the vendor, showing the vendor's name, a date, dollar amount, and the purpose. So that way, if someone comes in and questions it, why are you making this payment? You can say, here is what the support is. It was properly approved and paid. All right, next, let's see, I'm kind of watching the the chat as well, and I know Phil and Tyson are looking at those too. As far as defacing a voided check, tear off the signature piece, tear that out, keep it, put a big X on it, put it in a folder that says voided checks. There you go, easy as that. Next is credit cards. So again, we recommended that you don't use debit cards, but credit cards, that's fine. Although there are some risks associated with an organization using a credit card. It includes misuse of the credit card, purchasing again for non-business related expenses if somebody gets a hold of the credit card that shouldn't have access to it. So what we want to do to kind of limit our risks associated with credit cards is we want to limit the number of credit cards that we have. So not normally does every staff person need a credit card. So who actually needs to have a credit card? Who uses the credit card? So sometimes credit cards will be issued in individual specific name, and that person is responsible for maintaining that credit card. Other times an organization will have a credit card and it is used by multiple people. If that is the case, make sure you have a procedure in place where one person maintains that card and keeps it safe. And then that credit card is checked out so you know who is using the credit card and for what purpose. You really should establish a written credit card policy. If you don't have a policy in place and have credit cards and would like a copy, please let us know. We can provide that for you. Within the credit card policy, some things that you should consider including are card limits. So what is the limit of each person's card? What are the permitted purchases and disallowed purchases? Some organizations will not let the purchase of alcohol be included, for example. Just depends on the organization, but obviously you don't want personal purchases on there, but there could be other types of purchases as well. And then also, along with that, there should be the process for remitting the receipts at the end of the month. So when you use a credit card, there should be a receipt that you get. And we want to make sure that the receipt is the actual receipt that shows what was purchased. Oftentimes you'll get two receipts, especially if it's for a meal. You'll have the credit card receipt that just shows the total amount that was charged to the credit card. And then you'll have the receipt that shows what was actually purchased. We want to make sure that we get the receipt that was actually purchased, that shows the actual purchases, so we know what was actually purchased. There should be a policy as to then that person needs to remit those receipts to the organization within a certain time frame. Those receipts should then be reconciled to the credit card statement. That credit card statement then needs to be reconciled to the general ledger. Again, that's the second piece of that. So that way we make sure that we're recording all of the transactions that hit the credit card. There should be a policy in place for what happens if you use a credit card and there's no receipt. So for example, if you go to a parking garage and you don't get the ticket, what happens? Is it okay to just have that employee make a note, sign it, say this is for parking on this date? Or if you don't have a receipt, is it not reimbursable by the organization, and you're going to make sure that the employee has to pay for that personally? So there's different ways to go about that, but there should be some kind of policy in place. Again, require the original receipts to be submitted. Make sure it's done timely. We don't want to be reconciling credit cards 5 months later. We want to make sure that those are submitted timely. If you ask for them timely, you're also more likely to get them. Sometimes those can get lost after a period of time. And then there should also be a process for reviewing the credit card statements, again, reconciling it. Someone should look at the credit card to make sure that there isn't anything unusual on there, that there's no cash advances and those types of things. Next is payroll. So the payroll risks include overstating hours. So someone saying they worked more hours than they actually did, paying individuals for work that they just didn't do, or even paying ghost employees. So ghost employees is someone that is not actually an employee of the organization, but has been set up to receive a payroll check. So that's fraud. So what can we do with payroll? The big thing here is reviewing timesheets, making sure that the individual that said, yes, I worked 40 hours this week, that they actually worked 40 hours. reviewing and approving the payroll register to make sure that, yes, these are the hours that each person should have worked. This is what their pay should be, the proper payroll taxes were withheld or any other types of withholdings. Also establishing a process for any kind of changes, like adding or removing employees. Can anyone do that? Does it have to be a specific person? What kind of documentation needs to be maintained? Because again, I mentioned ghost employees. So how easy is it for someone to just add their friend to the employee payroll list and start paying them a salary for not working there? Utilizing direct deposit for payroll. I think most organizations do that now. Not often do we see payroll checks, except for maybe if there's a change or a new employee. And then using a payroll provider. And I know sometimes there has been issues with payroll providers not doing what they're supposed to be doing and committing fraud. However, normally, if you use a payroll provider, then they're the ones that can deal with all of the payroll taxes, making sure that's all set up properly, making sure that those are paid in properly and that type of thing. So usually it's best for an organization just to use a payroll provider for payroll to make sure that all of the taxes are withheld properly and paid in. One thing to note, just make sure your payroll provider is aware of nonprofit rules, because 501c3 organizations are exempt from paying federal unemployment taxes. So you should not pay FUTA. I have seen issues where they unfortunately paid FUTA. So state unemployment nonprofits have to pay, federal, they do not have to pay. Just a side note there. Next is financial reporting. So the risks here include misstatement, just not recording things properly. Your numbers are wrong on the reports that you're providing to management, to funders, to the bank, or just not recording activity. So for financial reporting, some controls is making sure that you have a detailed chart of accounts. Make sure you have a chart of accounts that is reasonable for your activity. You want to make sure that it properly accounts for different types of accounts, for your cash, for your assets, for your fixed assets, for your accounts payable, but then also for revenues and expenses. You don't want to combine contributions with earned revenue. So you want to make sure those are separate. If you get government money, you probably want to track those separately. Expenses really should be allocated by the proper type of expense. Again, whether it's supplies or rent or advertising. So what does your chart of accounts looks like? You don't want to have, 800 different accounts, but you want to make sure you have enough to have reasonable information provided to management when they're making their decisions. Using your budget. A budget is not, let's prepare it and put it on a shelf. A budget is a living document. We need to make sure that we are comparing our budget to actual. That's why we created the budget, to make sure we are on a plan to meet our mission and our goals. So comparing your budget to actual financials. If there's a variance, asking why. Maybe it's expected. Hey, we didn't get this grant this year. Okay, that's expected. But oh, that's wrong, and we really don't know why. Did someone steal that grant? What happened there? Why are there variances? Timely comparative financial reports. Again, making sure that you get your information timely. If you are not, either as a board member or management, not getting financial statements timely each month, that is a red flag. We really need to make sure that we are getting financial statements timely in order to make sure that we can make decisions, to make sure that information is being reported properly. Usually, if your financial statements are not completed timely, there is an issue, and we should be asking why. Make sure there's a policy and procedures manual in place for financial reporting for the accounting process, month-end checklist, which we kind of talked about, journal entries. So sometimes journal entries have to be made within the accounting system for non-cash items or to correct items or different reasons why, and that's perfectly fine. We expect journal entries to be made. However, when journal entries are made, we really need to make sure that we are, number one, have supporting documentation as to why that journal entry was made. And number two, making sure that the journal entries were approved. So again, at the end of the month, run the journal entry report, give it to the proper member of management to review, initial and date to show that they have approved that. Journal entries are one way and a major way that your financial statements can be misstated, because someone can go in and make a journal entry and move activity around, take activity out to make, after like the cash has been paid or received, they can do journal entries to move stuff around and make the balances look like how you're expecting them to look at, or make them look better. So we really want to make sure that we're reviewing our journal entries. Also, sometimes, people can just, if we're humans entering stuff in, we can just make a mistake. So making sure that the journal entries are reported properly. Next is technology. So just a few things on technology. The risks here include unauthorized access. Nonprofits, they have a lot of sensitive information. So you have information on donors, you have information on a lot of client information, especially those that, work in health areas, or if you get government grants, there's a lot of documentation you have to get for like eligibility for clients and that type of thing. So you have a lot of sensitive information that we need to make sure the wrong person doesn't get a hold of. So we really need to restrict our access, not only to physically, putting locks on the doors, but also, technology, who can access different software. Do they have to be on site at the office to access it? Can they access it remotely? That type of thing. Making sure everyone has a password and ID username to get into software. Please, please, please do not share usernames and passwords. Multiple times, oftentimes we see, well, here is the QuickBooks password and we just all share it. No, we do not want to do that. Because if something happens, we don't know who actually did it. So we really want to make sure that everyone has using their own username and user password. Make sure there's backups off site. A lot of organizations now use cloud-based software, so that's all taken care of, but just making sure that somehow your information is backed up. Antivirus software, spam filters, firewalls, all of that type of thing. Implementing policies on computer usage. So are there certain things or certain websites that you can't go to, that your staff can't go to during the day or while they're working or on their work computer? Limits on those types of things. Just training staff, what they should do and not do. Don't click on certain emails, if it looks fraudulent, just that type of thing. And then also just kind of doing an internal review on the system to see, okay, what's going on? Is there any kind of suspicious activity? So I know technology keeps becoming a more and more important role in our lives. And so just making sure that you have policies and procedures in place to protect your organization. Next, I want to talk about monitoring and culture of accountability, because even though we put in all these controls, and even if we have great controls, they're not going to work if they aren't followed, because it's really about the people within our organization and making sure that the people are following these controls. So monitoring and culture are key. So when we look at monitoring practices, we kind of talked about already about the financial reports to the board, making sure that they are getting those financial reports timely, making sure that they have comparatives to look at, year to date this year versus year to date comparative last year, compared to budget. So that way they can see what the expectations are versus what the actuals are. And if there's a variance, again, looking into why there is a variance. Because is the variance because, okay, we just didn't spend this much this month? Or is it because, hey, someone stole money or someone took the credit card and put a whole bunch of expenses that shouldn't have been on the credit card? What is the reason for those variances? Surprise cash counts related to cash, and then periodic policy audits. So again, just that kind of goes with your your written policies and procedures, going through those every so often, making sure that they're still relevant, making sure that, do they need to be updated? Do they need to be changed for any kind of new programs that we're doing, or we added a new site, or we added a new program, and that type of thing. And along with that is building a culture. So again, we talked about at the very beginning, it's all about the tone at the top. If your leadership, if your CEO, your executive director people are going to look to them. So you want to make sure that the management, the higher level, they're the ones that are behaving and making sure that their behavior is what you want the rest of the organization to follow. Also include control training on when you onboard new staff and when you train staff. So, you probably provide some kind of training on a staff on how to do their job. Make sure it includes what kind of controls and policies or procedures are within the organization. And then also encourage reporting of issues. Again, those whistleblowers. Hey, if you think something's going wrong within this organization, we want to know, because that is important for us to have a good culture and a good tone at the top. We are ethical here. This is important to us, so we want to know. And then we will address those types of things when they come up. Internal controls are everyone's responsibility. So the board, the audit and your audit and finance committee, management, employees, volunteers. So it's really across the board. In order for controls to work, it's the responsibility of everyone within the organization, and they all need to be aware of what the policies and procedures are and what their responsibility is within that system, but then also what would happen to them if they don't follow the controls. So oftentimes in a code of conduct or ethics policies, it talks about what, the good things are, what you should be doing, but it also talks about, okay, what if you don't follow this? What is going to happen? So looking at that piece as well. So as far as key takeaways, internal controls protect your mission and your resources. So again, it's not just about, not stealing cash or your fixed assets, computers, but it's also your whole financial reporting that goes out to your donors, to the banks, to your the government entities that you report to. Segregation of duties is key. Make sure that if you don't do anything else, look at your segregation of duties to see who is doing what, and then start with that, and then go on to the different written policies. And then also monitor regularly and foster a culture of integrity. Make sure that you communicate all controls to those individuals that are involved. Again, I just mentioned everyone needs to be aware of it. Your board, management, volunteers, your staff. Your organization's processes are only as good as the people doing them. If they don't understand their responsibilities and the reason for doing them, the controls won't work. You're not going to get the buy-in for them to follow it if they aren't understanding what they're supposed to be doing and why. So that is kind of our wrap up on controls. So again, if you have questions or comments, we will send out an email after this with the slides, and then also providing some contact information for our team if you'd like to follow up with any of those items. But I also wanted to provide you with some of our resources on our website. This is all completely free. So we have a bi-weekly blog that we put out that talks all about different kinds of things, from board service to Form 990, fundraising, all types of things. We also have bi-monthly webinars, and you can go out to our website and you can sign up for the upcoming ones. You can also view recorded ones. So this one will be recorded, and we'll send you a link after this is over to see the recorded ones. We also just started a new email newsletter that went out in July. If you didn't get that and would like to get it, be on that list, let us know. It includes, upcoming webinars, information for nonprofits. We also ask for feedback via our newsletter. We're always looking for new topics to cover, because we want to make sure the information that we're providing is helping you. That's why we're doing this. We want to help you get information that you need to advance your mission. So without that, thank you for joining us today. Again, if you have any kind of comments or questions afterward, feel free to reach out to us. We will provide you with a follow-up email, and thank you for your time and for your commitment to serving the nonprofit sector. Thank you.